Welcome back to Depreciation Lab. In this video, we are covering MACRS, the Modified Accelerated Cost Recovery System. If you run a business in United States and you need to report depreciation for federal income tax purposes, MACRS is not optional. It is method that IRS requires you to use for virtually every business asset placed in service after 1986. Now, MACRS has three rules that are completely non-negotiable. The first rule is that salvage value is always zero. Unlike straight line or double declining balance method, where you might estimate that what an asset is worth at end of its useful life and subtract that from the depreciation base, the IRS does not recognize any salvage value at all under MACRS. Every asset depreciates all the way down to zero, no exceptions. The second rule is that MACRS is an accelerated method. What that means for you, what that means for your tax return is that you get heavier deduction in earlier years of the asset's life and a smaller deduction in later years. This front loading of deduction is deliberate. It gives business a larger tax shield right when they have just made a capital investment. And the third rule is that you cannot choose your own useful life for an asset. The IRS has defined specific property classes, and every single business asset you own must be assigned to one of those classes. The class determines that recovery period, how many years you depreciate the asset, and you are not allowed to deviate from it. The MACRS replaced ACRS, that is Accelerated Cost Recovery System, in 1986 with the Tax Reform Act. For financial accounting purposes, you can still use method you like, straight line, units of production, and so on. But MACRS only applies to your tax return. The bonus depreciation in Section 179, expensing interact with MACRS. Those are separate topics, but they build on MACRS foundation. Now that we understand what MACRS is, what makes it different? Let's look at the two systems within MACRS, GDS and ADS. Within MACRS, there are two separate depreciation systems. The General Depreciation System, which we all call GDS, and Alternative Depreciation System, or ADS. For the vast majority of the taxpayers and the vast majority of assets, GDS is what you will use. But it is critical to understand when ADS is required, because using wrong system is a filing error. Let's start with GDS. GDS is a default. It uses accelerated methods, specifically 200% declining balance, to front load your depreciation deduction. Now, here is something that surprises many people. You do not need to manually calculate when to switch from declining balance to straight line. The IRS MACRS percentage table already incorporates that switch for you. In the year where straight line gives you a bigger deduction than declining balance would, the IRS table automatically flips to that higher number. Another advantage of GDS is that it qualifies for a bonus depreciation and Section 179 expenses. These are accelerated first year deduction that can let you write off a large portion of or even entire cost of an asset in year one. If you elect ADS, you give those up. ADS, on the other hand, always uses straight line depreciation, and it does so over a longer recovery periods. A 5-year GDS asset might be a 9-year ADS asset. A 7-year GDS asset might stretch to 12 years under ADS. So your annual deduction are smaller and spread over more years. ADS is required in 4 main situations. First, property that is used predominantly outside the United States. Second, listed property, things like vehicles and computers that are used 50% or less for a business. Third, certain farm property. And fourth, when calculating the alternative minimum tax. You may also voluntarily elect ADS. Some businesses prefer it for a book tax uniformity when they also use straight line for their financial statement. If you are unsure which system applies, then the answer is almost GDS. ADS is exceptional, not the rule. A common trap. A business owner uses a company car primarily for a business but drops below 50% threshold in later years. ADS then becomes required for that vehicle retroactively. AMT calculation require ADS even when GDS is used on the regular tax return. This creates a book tax timing difference. Now let's drill into exactly which asset fall into IRS property class, because this is where MACRS gets very specific. This slide covers IRS property classes. The recovery period that determine how long you depreciate each asset. I want to emphasize again, you do not get to choose. The IRS has assigned every business asset to one of these classes and you must use mandated period. At the fastest end, you have 3-year property. This is for the things like tractor units, race horses, and certain short-lived tools. The year 1 depreciation rate under GDS is 33.33%. You recover third of the cost in just the first year. 5-year properties are probably the most common class of modern business. Computers, laptop, cars, light trucks, and copiers all fall here. The year 1 rate is 20%. Note that the actual recovery spans 6 calendar years, not 5, because half-year convention we will discuss in a moment. 7-year property is a catch-all for general business property. Office furniture, fixtures, and most manufacturing machinery that doesn't have a specific class lands here. The year 1 rate is 14.29%. 10-year property covers things like boats and single-purpose agricultural structure. A 15-year, 20-year property are where things change. Notice that this class uses 150% declining balance, not 200%. Land improvements like fences, parking lots, roads, and landscaping are 15-year properties. Certain farm buildings and utility infrastructure fall into 20-year class. Then we get to real property, the two class that work completely different. Residential rental property, meaning apartments and single-family homes that you rent out, is 27.5 years. Non-residential real property, your office buildings, warehouses, retail stores, is 39 years. Both of these use straight line and not declining balance, and they use different convention called mid-month rather than half-year convention that applies to personal property. Year 1 rate shown assume that half-year convention, which is default for personal property. Easy way to remember, if it plugs in or drives, probably 5 year. If it sits in an office, probably 7 year. If it is a wall, 39 years. Computers used in home office must meet listed property rule to qualify for accelerated depreciation. That is a common audit area. Now you know recovery periods. Let's cover 3 conventions which determine exactly when IRS considers asset placed in service. Conventions are the most common misunderstood part of MACRS. The convention tells IRS exactly when your asset is considered to have entered the service, and this directly controls how much depreciation you can claim in year 1 and in the year you dispose the asset. The first and the most common convention is half-year convention. Under half-year, all personal property, meaning your 3-year, 5-year, 7-year, 10-year, 15-year, 20-year assets, is treated as if it was placed in service exactly halfway through the year on 1st July. This is the true regardless of when you actually bought it. You can buy a computer on 2nd January or 30th December. You can get same year 1 deduction either way. What this also means is that 5-year asset actually spans 6 tax years. You get a half a year in year 1, full 4 years in year 2 through 5, and then another half-year deduction in year 6 when you dispose of it. The second convention is mid-month. This one applies exclusively to real property, your 27.5-year residential rentals, and your 39-year non-residential buildings. With mid-month, the asset is treated as placed in service at the midpoint of the month you buy it. So if you close a rental property in March, you get a half March plus remaining months of the year, and that works out 9.5 months of the depreciation year 1. So if you close a rental property in March, you get half of the March plus remaining months of the year. That works out to 9.5 months of depreciation in year 1. The third convention is mid-quarter, and this one is a trap that catches many taxpayers off guard. It is triggered automatically. You do not choose it. If more than 40% of your total depreciation basis of all personal property you placed in the service during the year it was placed in the service during the 4th quarter, meaning October, November, or December, then mid-quarter convention applies to every piece of the personal property you placed in the service in that year, not just the Q4 assets, all of them. We will walk through exactly how mid-quarter convention works in the next slide. The half-year convention is the reason so many tax advisors recommend buying equipment before year-end, because even December 31st purchase gives you full half-year deduction. The mid-month convention for real estate means a month of purchase matters. Buying on the 1st versus 20th gives you nearly the same deduction. Both are treated mid-month. Mid-quarter is an exception that can wipe out year-end benefit of buying equipment in Q4 if it is too much concentrated there. Let's dig into mid-quarter because that is the convention that trips up even experienced tax preparers. Here is how 40% test works. At end of the tax year, you add up the total depreciable basis, meaning the cost of every piece of personal property you placed in the service during that year. Then you look at how much of that total was placed in service in the fourth quarter, October 1st through December 31st. If that Q4 portion is more than 40% of annual total, you have triggered mid-quarter convention. And here is the critical part that surprises people. It now applies to everything. Every asset you placed in the service during the year, whether you bought it in January, April, August, or November, must now be depreciated using mid-quarter timing. So what does that mid-quarter timing actually mean? Instead of treating everything as if it was purchased on July 1st, the IRS now uses the midpoint of the quarter in which each asset was actually purchased. For Q1 purchases, January through March, the midpoint is February 15th, which gives you 10.5 months of depreciation in year 1. For Q2 April through June, midpoint is 15th May, giving you 7.5 months. For Q3 July through September, that is August 15, which gives you 4.5 months. And for Q4 October through December, the midpoint is November 15th, which gives you 1.5 months of depreciation in year 1. Let me walk you through two scenarios on the screen. Scenario A, you placed $80,000 in Q1, $60,000 in Q2, $30,000 in Q4. The Q4 share is 30 divided by 170, that is total 17.6%. Well below 40%. The half-year convention applies to all the assets. The half-year convention applies and all assets get the standard rates. In scenario B, you place $20,000 in Q1, $50,000 in Q2, $65,000 in Q4. The Q4 share is 65 divided by 100, that is 65%. You have triggered mid-quarter. Now, you must recalculate every asset, including that January purchase, using IRS quarterly MACRS tables. And that Q4 purchase, that only gets 1.5 months of depreciation in year 1 instead of 6 months. The takeaway: if you are planning to make a large equipment purchase at year end, always run 40% test before 31st December. If you are close to threshold, moving a purchase to January of the following year might give you significant better depreciation in the first year. IRS publishes separate MACRS percentage table for each quarter under the mid-quarter convention. You cannot just prorate half-year percentages. Mid-quarter applies only to a personal property. Real property always uses mid-month regardless. Businesses that regularly make Q4 capital purchases should monitor this threshold annually as part of tax planning. If mid-quarter is triggered and you fail to use quarterly tables, the IRS can require an amended return, and there may be penalties for underpayment. That covers full MACRS framework, the 3 non-negotiable rules, the GDS versus ADS, 8 property classes, and all 3 conventions, including the mid-quarter trap. Thank you for watching. Check links below for MACRS percentage tables and depreciation lab calculator. We will go through MACRS method more deeply with practical examples in this video series. So stay tuned for that, and I will show you how Depreciation Lab handles this smoothly and gives you tax-ready return reports for your filing under IRS. Thank you so much for watching.